AI secular trading.
Welcome back to the Algorithmic Edge. Today, Mark, we're diving deep into a term that's circulating rapidly through the worlds of finance and technology: AI circulation trade. It has a dual meaning, referring both to illicit market manipulation and, more recently, to the massive, complex investment cycles driving the current AI boom.
That's right, Anna. We need to dissect both aspects, especially as these enormous tech partnerships, some reaching into the hundreds of billions of dollars, are being scrutinized under the lens of financial skepticism. We'll look at how AI is used to detect fraud and how AI might, ironically, be fueling the next great financial bubble through these circular investment patterns.
Let's start with the basics: what traditional circular trading means in the context of financial crime.
Traditionally, circular trading is defined as a fraudulent scheme in securities markets where a broker enters sell orders knowing that offsetting buy orders for the exact same number of shares at the same price and time have either been or will be entered. Crucially, this practice does not represent a real change in the beneficial ownership of the security.
And the purpose of this whole exercise is manipulation, correct?
Exactly. The primary goal is to artificially inflate trading volume to suggest a security has high liquidity or genuine market interest. Since trading volume increases are often seen as a signal that important company news is imminent, like a new product or management change, this manipulative strategy is very similar to what is known as pump and dump in the securities market.
If successful, the share price becomes fraudulently inflated, creating a false perception of value that collapses once the scheme is discovered, costing legitimate investors their funds. Historically, examples of this practice have been prevalent in markets like India, including cases involving major stock market scams, where participants created artificially high trade volumes through synchronized trading.
While traditional circular trading is old news, the methods used to detect it have recently become quite sophisticated, largely thanks to network analysis and AI. Existing widespread monitoring systems, often using machine learning techniques, have generally been unable to detect complex malpractices like circular trading, especially minute-by-minute occurrences, because they often lack access to the necessary short-term trading history.
This is where new specialized techniques come in, right? We have sources discussing a novel network-based approach specifically designed for detection in futures markets, drawing from real data from the Iran Mercantile Exchange, IME.
That's the one. This approach models investor transactions as a multi-edged directed and weighted graph where each investor is a node and each transaction is a directed edge from seller to buyer. The overall methodology involves three core modules. First, trade cycle extraction, TCE. This module extracts all trade cycles of various lengths from the daily trading networks. Interestingly, in the IME data analyzed, no cycles with more than 5 nodes were detected. Next, suspicious cycles selection. This focuses on cycles that have been repeated over several trading days or have identical subsequences of traders involved, identifying them as initial suspicious participants. Finally, transactional behaviors evaluation. This is the verification step, analyzing the time series of the commodity's price fluctuations over 3 specific windows.
I remember the time window analysis was key to differentiating malicious activity from random cycles.
Absolutely. The analysis verifies a specific pattern. The alleged manipulators must have bought commodity cheaply during the first time window before the cycle starts. During the second window, when the circular trade occurs, the price is expected to rise significantly above average fluctuations as the teamed-up investors trade small amounts of the commodity to create a false market trend. Finally, in the third window, the initial member sells the rest of their purchase batch at the new inflated price. Using this method on 618 trading days of gold coin futures data, successfully identified 24 suspicious cycles involving 97 potential anomalous traders.
Now let's pivot to the contemporary use of this concept. The term AI circulation trade or circular deals is being applied to the massive interconnected funding arrangements seen among leading AI companies and their infrastructure providers. This isn't illegal market manipulation in the traditional sense, but critics argue it operates on the similar principle, funneling money in a closed loop to inflate revenue, valuations, and hype. The total value of these overlapping agreements between major players like OpenAI, nVidia, AMD, and Oracle is estimated to be driving over $1 trillion across the AI market.
The central question is whether these transactions represent genuine economic growth fueled by external demand, or if they are simply a method of financial engineering, often referred to as round-tripping or vendor financing, designed to keep valuations soaring.
It is certainly fueling concerns about an AI market bubble. nVidia, OpenAI, Oracle, and AMD have created a highly interdependent network of funding and technological exchange. For instance, one Reddit user described the system as nVidia invests in OpenAI, OpenAI signs a huge contract with Oracle, and Oracle uses that money to buy nVidia chips. The poster child for this controversy is the strategic partnership announced between nVidia and OpenAI.
The figures are staggering. nVidia, the chip-making company and world leader in AI and accelerated computing, plans to invest up to $100 billion in OpenAI. This move comes just days after nVidia committed $5 billion to struggling chipmaker Intel.
This $100 billion investment is tied to OpenAI's progressive deployment of at least 10 gigawatts of NVIDIA systems for its next-generation AI infrastructure. This monumental undertaking is described as the biggest AI infrastructure deployment in history.
10 gigawatts is a staggering amount of power capacity. For context, 1 gigawatt powers about 750,000 homes, meaning 10 gigawatts is equivalent to millions of GPUs, potentially 4 to 5 million chips. The initial phase of this deployment is targeted to come online in the second half of 2026, leveraging the NVIDIA Vera Rubin platform.
And this complexity is amplified by other key players. OpenAI also struck a massive $300 billion cloud infrastructure deal with Oracle over 5 years for compute capacity, which itself spends billions on NVIDIA processors. OpenAI CEO Sam Altman views this computing infrastructure as critical and essential for the economy of the future.
We also see AMD joining the fray. Oracle is expanding its partnership with AMD, planning to be the first hyperscaler to offer a publicly available AI supercluster powered by 50,000 AMD Instinct MI450 series GPUs starting in the third quarter of 2026. Furthermore, OpenAI and AMD reportedly reached a multi-billion-dollar deal for deploying 6 gigawatts of AMD Instinct GPUs. This diversification helps OpenAI reduce reliance on a single hardware supplier.
The core issue critics point to is that much of this money is simply being passed around in a circle. NVIDIA generates revenue from selling chips to Oracle, then invests that money into OpenAI, which uses the investment to fund its Oracle contracts, fueling demand for more NVIDIA chips. This cyclical nature has ignited strong comparisons to historical bubbles, particularly the dot-com era. Analysts caution that these massive, interconnected investments, totaling over $1 trillion in circular deals, may artificially inflate valuations.
The risk is heightened because many of the key beneficiaries, like OpenAI, have yet to prove profitability on this scale. OpenAI's valuation has soared to $500 billion, yet the company remains unprofitable and is projected to only reach positive cash flow toward the end of the decade, possibly around 2029.
That's where the idea of juicing the numbers comes from. These agreements create a false appearance of sustained demand and growth, but the concern is that the funds are just cycling internally, not coming from genuine, long-term external customer revenue.
And the market reacts sharply to this hype. NVIDIA's stock jumped roughly 4% immediately after the OpenAI announcement, increasing its market capitalization by $177 billion. However, analysts warn that if the market collapses, this circular financing could be viewed as the original trigger of the bubble.
The stakes are incredibly high this time. If the AI bubble bursts, it could have catastrophic effects because entire sectors, from real estate and energy to global stock exchanges, are now tied to the expansion of this AI economy. The vast energy consumption itself is a growing concern, with 10 gigawatts demanding massive new power infrastructure.
So we see a fascinating dual economy concerning AI and circulation. On one hand, sophisticated AI and network analysis tools are being developed and successfully applied to detect traditional illicit circular trading in financial markets.
But on the other hand, the very sector driving this technological revolution, the commercial AI industry, is engaging in aggressive, high-stakes funding and purchasing practices that echo the structural vulnerabilities of past bubbles, driven by the need for unprecedented computational power.
As OpenAI CEO Sam Altman stated,
Everything starts with compute. This massive infrastructure build-out is essential for their mission to deploy superintelligence. But the reality is that the aggressive financing mechanisms used to secure this compute capacity, the $100 billion commitments, the multi-gigawatt deployments, are now facing intense scrutiny.
Whether these circular deals ultimately lead us to the promised land of technological breakthrough or crash the economy remains an open question. The success or failure of the AI titans hinges on whether the true economic value generated by AI in the coming years can eventually catch up to the trillions of dollars already invested in the underlying infrastructure.